Hello and welcome to the Gold, Ghosts, and Guns podcast for March 18th, 2024. My name is Tom Luongo, and we have a lot to talk about. It is episode 172, and back on the show, one of my favorite guests, and I think of the audiences as well, Vince Lanci is back with me, because there's a lot of stuff happening in, well, let's just call it the collateral space. And I talk about collateral at this point. I'm talking about oil, gold, silver, Bitcoin. These are the bearer assets of the 21st century as we move into a new monetary system, which is clearly, consuming the mind share of the politicians, us, the commentary at everybody, investors around the world. And so now everybody's in a scramble for collateral. And here we are about a little less than a month since the launch of the Bitcoin ETFs. And I was watching an interview the other day with my friend Caitlin Long, who I'm going to try and get on the podcast soon. She was on the Bitcoin layer with Nick Bhatia, and she was going through an interesting thought about why it is that as we're watching Bitcoin spike to an all-time high, 73,000 the other day, it's trading about 68 as we're recording now. The mining companies, the Bitcoin miners, weren't really engaging in this rally. Not companies like MicroStrategies, whose stock is a proxy for the price of Bitcoin, because they don't mine Bitcoin, they buy Bitcoin. Saylor, that's what Michael Saylor does. But the miners, on the other hand, are a different breed of folk. And it's an interesting, when I saw this happening and I heard Caitlin's argument, which I'll get into in a minute. I want to introduce Vince in just a second here and bring him into it. But when I heard about this, I'm thinking to myself, and I heard what she said, the person I wanted to talk to more than anyone was Vince, because the parallels right now between Bitcoin rallying to new all-time highs and the miners sucking wind, and gold making an all-time high and the miners sucking wind, just seemed too obvious to me. And I'm not sure what to make of all of it. And I'm not sure I'm convinced by Caitlin's argument and anything else. And we're not here to debate that per se, but this is part of the reason why I wanted to have Vince on the program, because I know more than anyone, he'll be able to explain how they do it, in how they manipulate the price of gold and how they manipulate the miners better than anybody else. And then we can free associate as to what we think is going on everything else. So Vince, I know that was a long intro on my part, but I really wanted to set the stage. Vince, great to have you with me tonight. Let's hash this shit out, shall we?
Yeah. I thank you for having me on again. It's always obviously fun to be here. Let's get right to the whole miner thing, right? So first of all, I'll just throw a couple of things at you, and then you just let me know where it stands. But the parallels between precious metals mining in general, and precious metals specifically, and Bitcoin are remarkable. Now, I'm not even getting into the mining yet, but to give you the synopsis, the industry in precious metals mining, and Bitcoin as well, centers on the producer and the end user and the intermediary. So the producer is the miner, right? And the end user is the investor. We're not talking about silver for this conversation. Let's just say it's investing. The end user is the investor, the owner of it. And in the middle is the bank. Now, for decades, since the 80s, since we're talking about precious metals here, miners have now, I'm not saying they can't rally, but back in the day, miners rallied because they were the only game in town. If you wanted to play gold, there really wasn't a gold futures market. I mean, there was, but it wasn't deep yet. But just staying on point here, the precious metals market ended up being dominated by the intermediary. The producer pulled the metal out of the ground, and the end user invested it. Well, the guy in the middle control the flows. It's a network, and they own the network, the distribution network, kind of like a bank doing an IPO. So what ended up happening was the producers ended up having to go to the banks to hedge, to get liquidity. And that was a good relationship at first, let's say. And the producers would sell to the bank, and the bank, if you're thinking about Bitcoin, think BlackRock in the middle. Think JP Morgan as a custodial bank in the middle. They would sell to the bank, and the bank would find an investor, kind of like any kind of a public offering of stock. Now, over years of that, the miners, and I'm speaking about the precious metals miners, they never really got smart. Now, there are miners that are smart now. And just to give you what I'm talking about, in the 80s, precious metals and companies, miners and oil companies, and let's say oil producers like say Exxon and Newmont or whoever their predecessor was, they were making money because they didn't hedge. They were, Texas hedge. They were getting long while they were pulling stuff out of the ground and adding to their longs. Now, when the oil bust of the late 80s and early 90s happened, the oil companies got smart. And the oil companies started hiring financial specialists who knew how to hedge production. And I saw this in the marketplace. I'm like, wow, the oil traders are really getting sophisticated like me now on the option side. But I would go over to the gold ring and I'm like, the gold guys are dumb shits. They're not really doing what they should. And you could see that in the options flow. And that's a long conversation. But the bottom line is the oil companies, right? Because we're talking about miners here. The oil companies said shit, like, I think Texas really had a rough time after the 80s because they didn't hedge. And Texas collapsed. Like, okay, we're going to have to hire some people that are financially smart. And so they started hedging their production. The precious metals guys, they didn't do that. And they continued to run poor companies. And they never hired financial people. They never hedged properly. And they became, you and I were talking about this before, they became addicted to the convenience of the banks, the intermediaries. And so the producer needs to hedge, he hedges. The producer hedges, they do what the bank says they do. They do this, we'll do that, do this. And so before they become, what's the phrase you were using? Related to Dune?
Oh, like it's just, I was calling it residual poison. The idea being
poison,
that they were on a antidote drip feed, that the banks had poisoned them, and in order to keep them alive, the banks would throw them a bone every once in a while to make sure that they were just solvent enough to stay going concerns, but also just but most of the profit was being taken up by the intermediaries, but in this case the banks.
Right. Now, that analogy I wasn't familiar with, but I used to just basically call them vampires, meaning the mine has to do their hedging through the bank. Well, why don't they do? Well, because the bank took them public. They have their checking account at the bank. They get a free toaster from the bank. They do their payroll through the bank. So they do their hedging. They have their master swap agreement. Yeah, go ahead.
I was going to say, and as Jim Sinclair brought up to all of us and educated us on back in the aughts, 15, 18 years ago, the banks back then did all the financing as well. And
Yeah.
so for a variety of non-recourse loans, meaning that, the bank basically owned the mine. So
That's right.
so the companies didn't have any other option but to take whatever deal the bank gave them.
That's
So
right.
the first layer of mining companies back in back in the late aughts, like 2007, 2008, 2009, during that period of the gold bull market, they were getting smart by at least getting different kinds of financing. And now the gold industry today, thanks to royalty companies like Franco-Nevada and Royal Gold and others, the industry itself started becoming the financing arm of the industry and taking that power away from the banks. FYI.
Right. No, that's exactly what happened. And that probably started accelerating after 1999 when Ashanti blew up. Now,
Yes.
just to give you an idea of how powerful the banks are, okay? And I'm not even being negative or just how incompetent the miners are. Goldman Sachs had bought Jay Aaron in 1999 or 1998 or whatever, and they wanted to get a bigger footprint in the gold market. So all these mines were, let's say they were all rated single A. And all the banks that were dominating the market at the time, it was Swiss Bank, which is now UBS. And they were going around, they were getting their swap and credit deals, their financing deals, which is what you're talking about, with this one bank, Swiss Bank, we'll call it, right? And they were getting, single A gives you this amount of credit line. Well, Goldman at the time said, we want more market share. And so they started giving them double A leverage at single A quality. So they were giving them more money than they were giving them a credit card with a 20,000 max when these people did not know how to manage a $5,000 credit card. Mm-hmm. And so doing that, Goldman Sachs took a lot of market share. Now, here's where it gets ugly. In 1999, for various reasons, Y2K, what have you, Ashanti went under. Ashanti went under for several reasons. Most of them were because of the advice they took from the bank. And the banking advice was this: Ashanti, we think you should hedge. I mean, I'm almost literally, and so Ashanti's like, okay, fine. You have to hedge your production to get this collateral, to get this financing. That's how it works. And so Ashanti's like, fine. So the market starts to churn for an unrelated reason, and the market goes up, and Goldman Sachs, the bank, and other banks, I'm not blaming Goldman, this is the way it is. Ashanti didn't know how to manage their risk. And so eventually Goldman Sachs calls up and says, hey, you remember those futures we told you to sell to hedge your production? Well, you got a margin call on them. Remember those calls we told you to sell because you had production? Well, you got a margin call on them. And that means we're going to freeze your credit line until you make good on it. Now, Goldman's credit department took a big hit. Goldman's traders got long, reversed, and Ashanti went under. Fast forward 5 years later, 5 years later, Ashanti gets purchased by, I think it's Rand. And who takes them public, or who brokers the deal? Goldman. Now, that's the MO. So that's the evolution of how the intermediary, in the Bitcoin case, it's banks and BlackRock, get in the middle, and they provide a service, but the customer never gets smart. In this case, it was the metals guys, and they got dependent, poison drip, however you want to call it, vampire, and they end up getting susceptible to the bank's whims. So now that's the mining industry with banks. Everything about the precious metals mining industry has been paralleling in Bitcoin right now. So by that I mean, all right. So what do you have in precious metals? You have a mine. Well, you have a miner in Bitcoin, right? What do you have in precious metals? You have a vault. Well, you have a vault in Bitcoin. That's the custodial services that the whales are using. Paul Tudor Jones, big player hedge funds, Paul Tudor Jones, Taraji back in the day, Soros, Gates, Buffett, they took delivery of silver. They didn't take it to their home. They kept it in the custodian's vault, and that was JP Morgan's, right? And it stayed there. And then they would hedge it or lease it out or do whatever you want. They did that. That's how it worked. When Buffett took all that silver, he didn't have it dropped on his doorstep. It stayed in JP Morgan's vault. So the same concept happens. JP Morgan and other banks say, we're starting a custodial service. I think Fidelity is like vertically integrated in that. And they say, all right, you give us your Bitcoin, we'll take care of it, we'll protect it, we'll put it in our vault, and we will give you insights as to what the market's going to do. We'll hedge your product, we'll lease it out, we'll do it. So they're doing with Bitcoin, to the extent they can, what they've done with metal. So now the model is replicating itself. I mean, they made so much fucking money in gold and silver doing that. It's an uncontested market for them. So now they move into Bitcoin. Now, the players are a little bit different, but the MO is the same. So if there's demand for the asset, in this case, Bitcoin, well, you need to control the source of the Bitcoin. Well, the sources of Bitcoin are the whales that the custodial businesses started in 2021, built up by JP Morgan. So they have coin, and that coin can be used to let's hedge it, let's not hedge it, let's sell it. You advise these clients genuinely because you actually have a lot of the flows, right? So BlackRock is an informed intermediary. And now you bring into the miners, and the miners, now I don't know enough about this yet, but if the model continues to parallel the precious metals model, then in precious metals, the banks short the mines. They short the mines because they know where their production goes. They know the price that the production is hedged at. They take the production. The mines in precious metals, until recently, the mines were a captive audience of the banks. So they knew where the hedging was. It went to them. And so they knew the math. I know that they're going to make this. They know the earnings before the precious metals guys do. So it's very possible, if this model is moving into Bitcoin, that the banks have a very good handle on the profitability of mines, and not adding in other factors like, which make it even harder to justify, in my personal opinion, being just naked long mines, which doesn't mean that they're not a buy. BlackRock you have to own it's really simple, right? You have to own the source of the Bitcoin. And that would be, there are three sources, because you need product, you need inventory. It's product. That's what it is to them. So one source is the JP Morgan custodial banks, the Fidelity custodianship that has all these whale Bitcoins. A second source is the miners. You need to control the miners. And the third source is you have this emergency tool that you can do a hard fork if you need it. I don't know the particulars of it, but that's the whole thing. They control supply. It's very possible that the miners are already under the influence of these intermediaries and custodians. And there are other real risks, but that's the parallel. If the industry is going from metals, from mining to mining, yeah, the Bitcoin miners are possibly being held back because of the risk. Number one, there are probably some real risks I'm not familiar with. But number two, if I were a bank and I knew every little thing about the Bitcoin miner, in fact, I know enough about it to create their competitor if I want to, right? I mean, that's what they do. JP Morgan bought, in 2021, JP Morgan bought a power generator in Texas.
Mm-hmm.
They knew what was going on. It's all about electricity, as you and I talked about. So if you have power and you have technology and you have these chips, then why can't you create a miner? So they're educating themselves, and maybe the franchise of the mines is not as robust as it could be because the banks are really a virus in this situation, not a helper. Does that help a little bit?
I'm not going to argue. Like everything you just said makes a whole lot of sense. Now, from a couple of things to remind everybody in the audience, which may seem counterintuitive, but when you think about it for 4 seconds, it really isn't, which is that both gold miners and Bitcoin miners and silver miners and oil producers and everything else, commodity producers in general, are net short the market that they produce.
Right.
They have to sell their production into the market. This is to make sure that everybody understands what Vince just said. It starts with the fact that they have to sell 90, 95, 98% of their production in order to cover their COGS, their cost of goods sold. Okay. Now, what the miners are supposed to do is give you a leverage against a price rise in the underlying commodity. That's what's supposed to happen. Because, hey, if I produce for gold, for example, at $2,000 an ounce, or at say $1,500 an ounce, the price of gold is $300. I've got 20% gross margins, 300 on 1,500, right? When gold goes to 2,000, that extra $200 is pure profit, baby. And now my gross margins go from 25 to 33. And if gold goes to 2,500, it's now 66. And while gold is only going up 10, 15, 20%, profitability of the miners is going up 20, 30, 50, 60, 100%, right? And all of a sudden, and it all just flows through the bottom line. You do the math. So now the bigger question. So for the Bitcoin miners, you have the same exactly the same scenario. They have far less risk in terms of building a mine out, and because there's not exploration and geology and the weather and all the rest of it. All they really have to do is manage the depreciation curve of the mining operations themselves and pay for the fluctuating power costs. That's it, right? For the most part, it's a pretty simple business. Now, one of the other things that we have not brought into this conversation is that unlike gold and silver, whose emission rate into the market is dependent upon the profitability of the market ultimately, meaning when the prices of the metals are down, production should scale back, right? And then when the price goes up, then all of a sudden marginal supply can come online. It's no different than the asphalt shingles market in Florida before and after a hurricane. It's no different. It's surge pricing, for lack of a better term. If I want to, get on the bad side of Wendy's, but the thing here with Bitcoin miners is they don't control the supply. The supply isn't market controlled. The supply is algorithmically controlled. Every 10 minutes, roughly, X number of Bitcoins bing, spring into existence. Next month, half of the amount of Bitcoins will come into existence every 10 minutes. This is the way it works. It's been working this way since 2009. Every 10 minutes, new block, X number of Bitcoins. Every 4 years, half that number of Bitcoins every 10 minutes, every 4 years, until we get to the theoretic limit of 21 million Bitcoins, right? So now, part of what is clearly holding the miners back in this scenario is that next month is the halving, is when the reward pool halves. And there's a lot of, and there's a natural skepticism as to whether or not the miners can be successful producing Bitcoin with basically twice the cogs. They're going to be producing for the same, if the difficulty number of the protocol does not shift dramatically, if ceteris paribus, it stays the same, then your revenue will halve overnight. Period, by definition. Because the amount of energy it took to produce one Bitcoin on Thursday was X, and on Friday it's half X. But that being said, it's not a single variable system. There's all sorts of things that go into this. As of right now, there's a lot of difficulty in the Bitcoin network because there's so much profitability with Bitcoin having broken out to $70,000 a coin, and even the average idiot can mine Bitcoin for 45,000. I mean, a guy with his laptop can mine Bitcoin for, say, 45,000 a coin. He's making money. Now, when the reward pool halves, he's going to come off the market. And then a couple of weeks later, the difficulty of the and when he comes off the market, the difficulty will adjust and the cost will adjust. And the price of Bitcoin mining adjusts based on the perception of profitability in the marketplace. So there's a lot of things that go into this. And if for gold, the analogy in gold miners is the price of oil going up? If so, is the price of electricity going up, which that's so much of the cogs for a gold mine, the marginal cost for a gold mine is that, because labor is pretty much not a fixed cost, but close to a fixed cost. Then you can understand it's an analogous scenario, but there's only a somewhat market mechanism here because the algorithm changes things. So we're having a perfect storm happen here in Bitcoin. We had a massive influx of investor demand because all of a sudden Bitcoin was available to every person with an IRA or a 401k in America. This was not the case before. Yeah, you could get it. Yeah, you could buy it. You could go to Coinbase and you could do the thing or whatever. But all of a sudden, you didn't have to worry about whether or not they were going to freeze your bank account because you opened up a Coinbase account, or you were going to do this, or you didn't have to buy a Trezor. You didn't have to do any of that stuff. You go into your Fidelity account or your Schwab account or whatever, and you buy Bitcoin the same way you buy Apple. That changes the dynamic. That can go into your 401k. It can go into your IRA. We didn't have that before. And what we're seeing, and this is the Caitlin Long's point, we're seeing an unbelievable amount of Bitcoin demand per unit time that we have never seen before. It is now a completely different market than it was pre-February 22nd. Period. It's a different market because the total addressable market of Bitcoin within the United States is different. And it's now an exogenous demand that wasn't there before because previously, without there being ETFs, we had a demand suppression. We had supply was the same, demand was suppressed artificially through regulation, and now that regulation limit goes away, and then all of a sudden demand gets to finally express itself properly. One could make the argument it's the concept of antecedent demand. We don't know how much demand there is for Bitcoin until we actually make the market frictionless. In the same way that I would always argue that Bitcoin itself is a commodity, even though it's a digital commodity that was sprung out of whole cloth because there was antecedent demand for an asset like Bitcoin, and then the market proved it to everybody by buying the damn shit. Like, it's the same argument. In the end of the day, by the way, it's the quick and dirty argument as to why Bitcoin satisfies Mises's regression theorem the day the Genesis block went alive. FYI, that's a digression on my part. So So now what I want to ask you, Vince, is the following. We know from what you just said that the banks are the ones actively there trying to make money in the gold and silver space because they control the flow. They're going to want to do the same thing in Bitcoin. Now, wouldn't it make sense that there would be I don't even know if it's an excuse to short the miners, create the FUD to short the miners while everything's breaking out while the price is breaking out to the upside. For what reason? As always, to scoop up shares on the stink bid, to fleece the Muppets, as always.
The short answer is, if I were a bank and I knew that the price of Bitcoin was tied to the miners, I would know what the miners should be worth. And therefore, without even being conspiratorial about it, I would be actively trading the miners as if they were convertible bonds against the shares themselves. So the banks are definitely valuing miners on several ways. One is, how good is the miner? How efficient is their cost? How do they run? And guess what? We're going to see that, we can anticipate their production to be X. We know the price is there. Therefore, we know what they're worth. And so the miners have a problem. And the problem is, I think, right? And I haven't heard Caitlin's interview yet. I'm going to after this. But the miners have a problem. And the problem is, if the banks genetically need to have a source of Bitcoin, and they know how to value precious metals miners as a result of the price of the underlying, then they have an even better, easier time modeling Bitcoin miners. And I'll explain why. It's really just a rephrasing of what you said. When you were talking about hedging, right? A miner grows gold. He pulls it out of the ground and he's like, okay, I have to hedge it. I'm going to sell it 6 months from now to Joe, the jeweler down the street. But between now and 6 months, it's just sitting there. So let me sell some futures. So they kind of hedge their risk. And that's what they do. They hedge their production because they have to pay bills. If the price of gold goes down and they haven't sold it 5 months from now, and they have to make payroll or they have to pay for their drills, they're screwed. So they hedge, and that's how they hedge their cash flow. That's how the mine operates. Now, this is really important, and this is a huge difference if what I'm understanding about what you just said is correct. The difference between a precious metal miner and a Bitcoin miner, which makes Bitcoin miners infinitely easier to value from a bank's point of view, is the following. A precious metals miner, when the price goes up, forgetting about financial leverage, let's say they have no debt, right? A precious metals miner, they have what you described as basically operating leverage. So you already have a drill, you already have your employees, and the price of gold is $1,000 an ounce. Okay, well, the price that it cost you is $998 an ounce at this level. So you only dig down to that level and you run your guys on an 8-hour shift. And then the price of gold goes to $3,000 and you say, well, fuck, I can take the same equipment, run double shifts, run triple shifts, only increase my cost incrementally. My electricity goes up, my fuel, right? My electricity goes up, but my fixed overhead remains the same. I don't have to buy another drill. I don't have to buy another shovel. Maybe I have to pay for more labor, but your capital expenditures remain the same. That's operating leverage. And obviously it's a double-sided sword, double-sided blade. Double-edged sword. Thank you. Double-edged sword, right? But that's the beauty of a well-run mine. They have operating leverage. If you know they've got X amount of reserves, and you know the price is here, and you know how much it costs them to bring it out of the ground, then you can predict quite accurately the operating leverage, what it will translate to on their bottom line. As you said, incrementally, their expenses go up, but the profits go almost completely to their bottom line. That's operating leverage. Now, Bitcoin miners, if I understand them correctly, don't have operating leverage. They don't have scale. They're dependent on power, which is their only real cost. Their capital expenditures are depreciating assets from the moment they get them, and they're dependent on better technology to make it easier for them, and the franchise isn't really that good. So putting myself in the shoes of those banks that make that money off of mines by handling their production and by seeing if a mine is poorly run, shorting the shit out of it, right? Or taking advantage of them financially. And then you take that model, which is the model of Darwinistic, opportunistic, I wouldn't call it avarice, but just say, capitalism, take that model and pull it over to Bitcoin. And now, as you say, if the price of Bitcoin doubles, forgetting about the halving, if the price of Bitcoin doubles, their profits double. Can they turn on more computers? Yes, they can. Will that give them operating leverage? I'm thinking out loud. Yes, they can, but not the kind of operating leverage you get from a mine, because, as you said, the production is algorithmically controlled. It's not controlled by your scale. Go ahead. I'm sorry.
To be honest with you, no, they can't even turn the computers on or off.
Oh, okay.
Okay,
So
no,
there you go.
Honestly, because the chips themselves are on a depreciation schedule. The mining machines themselves are on a depreciation schedule. I mean,
right.
Because that Bitmain's going to come out with the new miner next, the new 3 nanometer miner next year or whatever, and blah 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 blah.
Right.
And so it's they literally have to keep them running 24/7. What they can do, what's interesting for them is the following, which is that they can buy electricity during non-peak hours. Where Bitcoin mining is really, really interesting is that Bitcoin miners, when they're smart, they're using the excess energy that the grid produces anyway, just to keep the friggin' grid pressurized. Right. The one thing people don't understand about the electrical grid is that 30% of the electricity we generate goes to ground, because in order to keep the network of the grid pressurized, i.e. the voltage up, that's what it is.
It's the ultimate flow rate. You have to keep it moving.
These pipes are pressurized, and unfortunately you have to keep, it's like what, just think about like trying to keep a water pipe pressurized, but you have to you can't cap the end of it.
Right.
You have to keep that seems stupid, but that's the way electricity works, folks. You can't shut it off. Otherwise you don't have a circuit.
It's not much different than natural gas.
Right.
It's so, not the
natural gas is similar. Right. So for the Bitcoin miners, what they can do is co-locate with power plants and whatnot, and pull that excess production off of, they can make the power companies more efficient. They're actually, Bitcoin mining is a very symbiotic relationship with the power companies, because the power companies are sending 30% of their thing to ground, and they're getting nothing for it. They can't sell it. People aren't using it. It's just going to ground. So if the Bitcoin network takes 1% of that, or even 2% of that, which it doesn't, it takes even less than 1% of the entire network.
Right.
Then the power companies are now happy to enter into a co-location agreement with them in order to generate revenue off of their leftover, their power that they're generating anyway. It's not because they're not causing a massive voltage drop on the network per se. What they're doing is actually keeping the grid fully powered all the time, because the power company can make money when consumer demand is low. Okay,
right.
There's no thing.
Right. I mean, that's actually the flip side of not having operating leverage. Meaning, I'm a Bitcoin miner. If I'm well run, I'll try not to buy during peak. I'll try and run during off peak.
Right. You'll just run, or what you'll do is you'll set up an offtake agreement with the power company, and a lot of them are doing this. I would imagine if they're not, then they're idiots. Which is to say, look, if you're going to charge us less during non-peak hours, and they'll charge us going rate during peak hours, and and that's just the way it goes, and that's what they do, and that's what they should be doing, and I know that's what a lot of them are doing, because everybody wins in that environment. And that, again, just a bond equation about who makes there's an X amount of profit in this thing, and how much of this profit do you want, and how much am I going to get, and if people are smart, then they come to a deal and everybody wins. Capitalism.
Because it's electricity, they remove peaks and troughs. It's seasonality. Yes. It's actually Bitcoin is it's a disruptor in one respect, but it's also it's very Darwinistically and more efficient. It makes things more efficient. So
because now we're literally now tokenizing and holding on to that which we produced, and we're not just throwing it away.
right.
We're actually accreting value to the society in that respect, if you really
Right.
stop to think about it.
So I guess I have a question then. The question is, if to the extent that it can be replicated, look, I believe that the banks are shorting Bitcoin miners. I believe they're shorting them for several reasons. One, they would be shorting them because they know which ones are not being run well. It's still a young industry. It's still, I wouldn't call it mom and pop, but it's kind of like, your independent East Coast heating oil people. It's probably not hugely consolidated yet. It's still fragmented, and you still haven't seen a low-cost producer come out with a killer setup that puts everyone else out of business. So my guess is the Bitcoin industry, mining industry itself will consolidate as the banks short them, try and replicate them or take care of their favorite miners if they have them. Number one. Number two, as you said, there's no operating leverage, just zero operating leverage, but there is an ability to work with non-union electricity, that type of thing. So that's the second reason. And then the third reason is the banks know exactly what Bitcoin miners are worth because they know that, like you said, their cost basis will possibly double. Well, theoretically it doubles because their production is cut in half. And finally, the miners, well, I mean, the miners are a source of production. They're not going to be allowed they're like precious metals firms. They don't have the people that are hedging yet, at least professionally. Maybe they don't. Maybe they do, but they're not as good as the banks. I have a report from Standard Chartered I want to give to you. I'm going to be sharing it with my subscribers tomorrow, and I'll give it to you after this program to give to your Patreons as well. It talks about Bitcoin a lot. I haven't looked at it yet, but it may talk about the miners. I have a lot to learn on that, but I think your Patreons would appreciate that.
That would be very much appreciated. The thing is, for the mining companies, is one of the things to remind everybody is that the marginal producers will fall off at the halving. So it's theoretic that it's going to be half. They're going to make half the amount of money. No, it never really ever works out that way. What happens is the marginal producers drop off because they're not profitable. They turn the miners off and they move them over to mining something else, right? Because there are plenty of other SHA-256 encrypted coins out there that they can go mine and go make some money in. I don't know, Monero, whatever's still out there doing SHA-256, Zcash, whatever. And that's what they'll do. And then you'll start to see the pumping of those altcoins because now the miners are long. These other are now producing these other coins, and then they got to figure out a way to pump the price on those things up. And you'll see. And there's always that daisy chain that happens every time Bitcoin goes through one of these things.
It's like an alt seasonality, right?
Yes, there is a definite seasonality to the altcoin market, or is it the Bitcoin maxis, or is it the Bitcoin maxis like they call them, the shit coins? That's
right.
But for Bitcoin, what that means is that the difficulty for the network will drop, which is directly proportional to the cost, the amount of energy it takes to generate the hashes necessary to solve the encryption. So
miners, who do you want to own? Who do you want to own? Who do you want to own in the Bitcoin mining space then? That's my question.
I'm not giving that one out. That's what subscribers to the newsletter are for. Sorry. I mean, you know what I mean? What you want in the miners, you want people who are who have the latest technology or have the capital to be able to afford the latest technology with the best co-locations, with the lowest price to mine, who have the most flexibility and they have the most operational flexibility. That's what you want. And it really does come down to lowest cost of production.
The best run companies are going to have the lowest cost of production, have the best networks, have the best negotiation with co-locating. So that those are the mines that are going to do well.
Right. Yeah. No, absolutely. But what's interesting is that this scenario where if Caitlin Long is correct, and again, I know you haven't watched it yet, but it was really fascinating for me to think that in this moment in time when we have this massive amount of investor demand into a new product that from the way she described it was that by law, they have to make sure that they are properly hedged of their time risk after, you put your money into the Bitcoin ETF. They have to go out and source the Bitcoin. If there's any opportunity where there's time between the time the money shows up and the time that the Bitcoin is sourced and then delivered, for whatever reason, theoretically it should all be like 20 minutes, but it's not. But we all know in reality it's not that, because there's more investor demand than there are new Bitcoins coming on the market. So the miners can't fulfill this demand. Okay. Even at, and even as we've seen the price go from 45 grand to 70 grand, we're not seeing investor demand drop off on on a per time basis, i.e. on a per daily basis. So as of right now, a month from now, this could all be academic. But what it means, but it's interesting, because to me, it screams what happened the last time you and I were on the podcast about what was going on in the physical gold market, that we were having a massive run on physical gold here in the United States, and the gold was flowing to China. And we saw that through the arbitrage between the Chicago and London price and the Shanghai price. But what Caitlin was arguing was that in the Bitcoin space, because there weren't good hedging vehicles out there, i.e., there's not enough liquid futures to hedge the need to go and to go short against the long of having to go buy Bitcoin, that they were using the miners as the hedge and shorting the miners. I think there may be some of that, but there's also then the opportunity to go, yeah, let's short the miners, because what do they always do in gold? We've seen it all this year. Well, gold's rally isn't sustainable. Look at the price of miners.
Right.
They're out there shorting the fucking shit out of the goddamn stocks, and then using that and going on CNBC and on FinTwit to turn around and go, oh, by the way, the reason why this isn't a real bull market in gold is because the miners aren't breaking out. Like, well, no shit, Dickless, you're on both sides of the fucking trade.
Exactly. Well, I mean, just to
they're doing the same thing in Bitcoin. It seems obvious to me.
But wait till I tell you this, all right? Because this is what's coming to Bitcoin miners in general. If there were, the banks have these structured notes, and they, the CDOs, CLOs, CDMs, whatever you want to call them, but all the things that are in the Big Short, they create these structured notes with gold miners in them to short the gold miners for private placement. These things exist. I'm reading them now, trying to piece together the collateral thing, which is what you're talking about. So yes, these structured products, I call them, these structured products, there are structured products out there that bet on the GDX going down. And they don't hit the market because they don't want the market to move. They want it to stay. They do it with GLD. They do it with SLV as well. Anyway, so the banks love to short equity assets that they can value off of a commodity. So I believe, without reading it, without hearing Caitlin's conversation, but listening to your translation of it, I believe Caitlin's right. I believe the banks are definitely the banks, not necessarily. I don't know if BlackRock's allowed to, but the custodial firms and the market makers are trading the Bitcoin miners like convertible bonds. And that's what they do. It's an options trade. It's like the miner makes 5% of production. Well, then I'll hedge 5% of my production that way. That's what they do. So the second thing with that parallels that this is about, as you started the whole show about, this is about collateral. There's a shortage of collateral. What is it? Shortage of gold? No. I mean, yes. Right? Shortage of oil? Yes. Okay. So shortage of collateral, that the gold thing is about the collateral exists, but it's not where it needs to be. Right? So the shortage of collateral is because the gold going from here to there. But the Bitcoin collateral doesn't exist yet. Okay. So, and what's worse is,
what I'll say is this: it does exist because most of the coins have been mined. It's not been properly valued yet.
Oh, right. Well, that's what I'm getting to. This might be the ideological crux of the whole thing. Not about the miners thing, but about the price of Bitcoin. Just speaking like a maxi for a moment. If you let the price of Bitcoin go where it should go, to get people to sell it again, then you would have no more problems. If you had a free market environment, where's the price of Bitcoin gotta go? I don't know, but put all the buying in there at the same time, let them chase each other, let them FOMO each other, and let it go to 100, 200, 400, a million. Who fucking knows? But when it gets there, someone's going to find a price that they're willing to sell. And the market will be incredibly volatile, but in the long run, due to free market circumstances, will balance out. Now, that's what you want to have in a purely capital L libertarian world. And I'm all for that. There are problems with that, though. The biggest problem with it is, and this is the ideological part, see, the US banks and the US government are frenemies. They always have been. But the banks don't give a shit about the price. They want to fill it and bill it. The government's like, you know what? You better not let this go too high. We don't want to have that kind of attention. There are no more God candles, at least not lately. You should have had at least 20, 10% God candles. You should have had those, but you didn't. Why? Because the banks, and I'm sure of this, because this is another thing that they did in metals. They're spoofing Bitcoin lower using futures at opportune moments during US hours. Zero Hedge had talked about that, but the players in that are the Jane Streets, Jump Trading, Citadel, Virtue's probably one of them, but we know that Jane Street's doing it. So what are they doing? They're selling futures hard and sloppy to get a seller to create liquidity for them. It's like running the stops. Yep. It's the same exact idea. The mechanism is the same. So ideologically speaking, I'm a bank. Right? I'm a trader at a bank. And I'm like, I don't give a shit. If I know that I have $1 billion worth of buying, you know what I'm going to do? I'm going to run it higher at night. Look, this is how the banks operate, right? I mean, this is why I know there's a problem at the banks right now. The banks go like this. How many buy orders do we have coming in for the New York Open? Oh, we've got 1,000 buy orders. Fine. I'll buy them in the night market lower, and then I'll sell it on the open. And that's typically what happens. So it's like, if I know there's buy interest, I'll buy it at night. Oh, 1,000 are going to be bought. All right. So I'll buy 800. And then the market opens up and they sell it and they match up. And the market may continue higher. It may go lower, but they pre-order inventory to satisfy demand on the New York Open. Now, here's where Bitcoin is screwing everything up. They're buying their 1,000 coins at night. And they're estimating, this is the models breaking, they're estimating 1,000 coins demand in the morning, and they're getting 2,000. They're getting 3,000, and they're getting 4,000. And they're like, fuck, we can't satisfy it. So the price runs up. The price runs up. The government theoretically knocks on the bank's door and says, hey, what the fuck are you doing? You can't let this happen. You can't do that. And by the way, it's also bad business for the bank too, because if they can't fill the clients at a reasonable level, they lose the business. Like, nobody's buying this, they'll go buy something else. So the banks want the market to go up in a controlled fashion with the occasional spike. The government wants the government to, doesn't care about the price so long as it's not fast. So the banks go back to their thing. I'll buy 2,000 coins at night. You come in the morning, and if you look at the chart, it's like Bitcoin goes up 5% at night. It's unchanged to down 1% in the US. It goes up 7% at night. It's unchanged to up 1%. And you're like, that's the front running creating the problem. So the government, now I'm making this up, but this is what happens in metals and happens in every market. The government says, listen, I know that you don't want the market. They're like, the government, the banks are saying, look, we're buying it at night to not disrupt the US market. But we don't know how many they're going to buy. And so when they buy more, we're screwed. We have to buy it too. We can't find it. We can't find it like we find gold around the corner under a rock. It's just not available, and we've already shorted the shit out of the miners, so I mean, that's part of the game. Okay. So now, and this is all coming together for me now. Now the government is like, well, again, hypothetical. The government's like, well, you can't let this thing go up so aggressively, so fast. And so the banks say, okay, during a thin time, we're going to sell some futures to get it down so we can buy some physical. We're going to shake out some week longs. Like, for example, there was a week long in the market yesterday, just yesterday. And that week long had to sell Bitcoin in a panic because they were long. I'm sorry, they were short MSTR. They were short MicroStrategy against long Bitcoin. They thought MicroStrategy was overvalued, so they were buying Bitcoin. Well, MicroStrategy had a short squeeze, market ramped, they puked the MicroStrategy, they bought that, and they had to puke the Bitcoin. And so every so often, they're going to find a whale to puke in Bitcoin who hasn't leveraged some way that's just esoteric. And so now you're in a situation where they can't get the coins, right? They don't have a deep enough market to hedge. And they're trying to buy them at night when all the volume is down. Like you can't go back to the libertarian thing. You can't get the buying digested without a price reflection. And in order to have a price reflection, you have to piss off the government, which wants this thing controlled. The banks, I'm not saying they're panicking, but if I was a bank, I'd be panicking because they've underpriced the demand. And I know this from listening to some things that Saylor said. When the Bitcoin ETF was approved and studying the regulations, that made it okay for regular companies, not hedge funds, regular companies to say, you know what, I've got $1 billion in cash. I've got 800 million of it in 10-year bonds. You know what, let's put 100 million of it in Bitcoin because it's now a liquid cash thing that can be marked to market. I don't have to worry about my shareholders being upset. And boom, this isn't retail buying all this. This is like, Apple saying, okay, I'll buy some, right? And
Apple's
so,
got more money on their balance sheet than most countries.
Right now, granted, this could be a big back end risk if someone gets out, but the bottom line is the banks are not like, look, the banks are being eaten by Bitcoin, and they may have to call the government in to help them or have a hard fork or start their own mines. But no, this demand,
or allow the price to run.
no, they're not going to let that happen. They'll declare. How about this? Let's go back to the gold parallel, right? All right. If the price, let's say overnight, China says buy all the gold, right? What's the U.S. going to do? I mean, rhetorically speaking, the COMEX is going to sever deliverability against price, right? So you'll have, and that's the disaster here. If they were to do that, if they were to let the price run, they have all the flows in the U.S. now. They've gotten it out of China, most of it, and they have all the flows in the U.S. If they let this thing go up, that means they can't control the steam coming out of a boiling pot. And that means they'll have to say, the Bitcoin ETF is no longer Bitcoin. It's cash settled 6 months after it starts. And that's a disaster. That's credibility destroyed for the markets, for the US. And Bitcoin goes back to just disrupting everything again. Anyway, so yeah, I think the banks are fucking getting a little bit nervous.
Okay. That sounds great. I'm glad you said that, Vince, because that just makes me happy, and that furthers my conviction that not only do you want to be long the underlying asset, but that you want to be long the miners as well, because they can't hold them because the numbers are going to start coming out of the miners where they all made ridiculous amount of money, where a number of them made ridiculous amount of money, and at some point you're just gonna have to look at them and go, dude, we made $2 a share. Like Wall Street's gonna say, oh well, they're only supposed to make 20 cents, and they come out and they make $2. Like, they can't suppress that long enough. Eventually that information makes it.
Here's the thing. They can't suppress that. They can suppress that. I mean, I'm not contradicting you, but hear me out. You can suppress the gold miners and the gold, but you can't suppress them both at the same time in this age of collateral.
Right.
So you can't suppress Bitcoin and Bitcoin miners if Bitcoin starts roofing. And I really, that I'm thinking about this, I really think that the banks are making a shit ton of money, and in the short term, and in the long term, they're going to have a problem. And the long term is, they're going to have to, you know what? They definitely want an Ethereum token to be launched so they can say, it's time for you to take your Bitcoin and roll it into it. They need sellers.
There's going to be a big bait and switch coming.
There are no sellers of Bitcoin. That it needs to go to like 400, 500,000. That's what it needs to do.
Well,
Whatever it's.
and I'll be honest with you, Vince. I think what we're looking at now is I'm always very skeptical because I've been in this market a long, long time and I've watched them play these games many, 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 many times. So I'm always like, well, they'll let it run another double, and then we'll get price discovery. I'm using my evil air quotes here, folks.
Yeah.
And then we'll get the pump and dump, and we'll fleece the Muppets again, and blah blah blah. And they'll do this, and they just know when they have to get that done. In gold, they play around with margin requirements on the futures market, but I think what we're looking at here is this moment in time where the Bitcoin futures market, which is now roughly 5 years old, 6 years old,
Right,
is still not liquid enough to handle what retail level Bitcoin demand looks like in terms of Bitcoin, which is a function of them not allowing these ETFs into the market. They delayed these ETFs for so long and cost so many that yes, the steam kettle is boiling and the valve has broken, or however you want to put it, and they don't know how to break. You're absolutely right. Like they're better. The better thing for them to have done, and this is but again, control freaks and never learn. They always try to keep the basketball below water for as long as possible.
And they don't know anything,
and then they get burned when the whole fucking thing blows up on them, and then they expect us to deal with it. Like they should have approved the ETFs 4 years ago, and the big and taken the hit when Bitcoin was 12 grand, was 15 grand, not 70 grand. Right. And they tried to do that, and then they were too aggressive during the last bear market, taking it all the way down to 16 grand. Like they did this to themselves. The banks, right, the government, the regulators, all these fucking control freaks did this to themselves. They should have allowed Bitcoin to run the 60 grand last time, bring it back into the 30s so that there's not a tremendous amount. There's not everybody gives up for 4 years. And then all of a sudden, boom, it now goes from 16 to 70 in 3 freaking months. And we get the halving and we get the ETFs. And it's like, dudes, you should have done the ETFs back in the 20s.
There's a phrase that one of my mutuals, who's a very literate Bitcoin person and holder, said. We were using war parallels. I was talking about fighting a new war with old tools, which is your point about the banks are doing what they always do, but they're not adapting, they're not adjusting, and by the way, they don't have to adapt or adjust because they'll get bailed out by the government when they cry uncle. But here's what he said to me, and he put it in like one sentence, and it's a little cryptic, but he said the banks are fighting this war with Bitcoin using Maginot Line Gen 2 warfare, but this is meaningless against Gen 3 blitzkrieg. And so that parallel, I think that statement, I think, is very similar to the whole. The banks have all the ways in the world to let the steam out of the pot. And they don't have as many ways. They don't have the key to the production. They don't have enough of a custodial business built up yet. They don't have access to above ground coins that they do with gold. They don't have this ability to say, you know what, I'll give you your gold later. Let me give you some interest on it now. They don't have that. People want the coin. I like to say they want the gold. Well, they want the coin. And if you don't have the coin, which is the collateral, then all your steam escaping valve things don't work. And there's only one steam escaping thing that will work, and that's the capital L libertarian, let the price find its level.
That's right.
If it goes high enough, Apple's going to say, fuck you, I'm not spending that money. And by the way, that's all symptomatic of too much money being out there chasing too few goods.
Exactly.
That's what a bubble is.
Yeah, and this is where we are. Yes, exactly. And it's and if they were really really smart, they would allow. And I'll be honest with you. Okay, so there's a couple of things here that we're glossing over in the way I view the markets, because I bring in the other side of this, which is I've been arguing for a long time now that this now I'm going to like shift the discussion a little bit. Say, look, I've been arguing for a very long time since the Letitia James settlement with Tether a couple of years ago. That is, I think, and then after all the stable coins were executed, you and I've talked about this, and I talked about it in multiple podcasts, where I believe that the Fed went on the warpath in 2022, 2023, destroying all the stable coins on purpose, by kind of knocking them down one by one, culminating in FTX to leave Tether tethered to the Fed and into the banking system,
Right.
as a treasury liquidity sink. And as Bitcoin, I think Bitcoin's being legit. They're trying to legitimize Bitcoin as a collateral strategic asset for the U.S. banking system, but they don't want the price to rise this, as you put it, this too quickly, because it upsets too many apple carts. And I'll be honest with you, I can almost understand that rationale. And I'm not, I don't care one way. Me personally, I don't care one way or the other, because what matters here is that Bitcoin is doing what it has to do, which is to bring collateral, hard collateral, back into the system. But now when you start thinking about Tether, as in order to keep Bitcoin liquid, in order to keep actual Bitcoin trading liquid, and then by extension, the futures market and everything else,
right,
you need to have an antipode that trades for real. And that's why Tether is it. And so you watch the Tether market cap carefully. And as long as it's rising with the Bitcoin price, then it's allowing for greater liquidity. It's also allowing for a sump of treasury bonds, short-term treasuries, a little bit of gold, a little bit of Bitcoin, yada, yada, is being held on Tether's balance sheet in order to liquefy, in order to under Tether. That's part of this equation as well. And it may be a rounding error in Daniel DiMartino Booth's terminology. It's only $100 billion, but it's $100 billion worth of marginal flow, because it's marginal short-term treasury demand, right? And it's not stock, it's flow. So I'm fine. I get a little skeptical. Then once we start, I'm glad we went down the path that we did, because it explains what all their incentives are. But then at the same time, I do think that their incentives are, on the positive side of the trade. They just want to control the price rise, because that's the way they're going to control.
Wait, you mean they meaning government
the
or
banks
banks?
and the banks and the Fed. I think the banks and the Fed are, and this is where Caitlin Long and I. So to the last time she and I talked, disagree. I think, and I told her this. I said I think they're on the long side of the Bitcoin trade. I think
they have a frenemy. Bitcoin's a frenemy to them. It's a sponge. And it's a sponge. I'm sorry to interrupt, but I just want to
go ahead. I'm done.
It's let's put it this way. If people weren't buying Bitcoin, where would that money go? It might be going into fucking Nvidia. Like, it is a sponge, and you do get marginal demand, and demand at the margin, not weak demand, but demand that otherwise would not be soaking up extra treasuries. Demand, like it really is kind of a look. Here's why I love it if I'm the government, even though I don't like the price action on a day-to-day basis. I love it because the U.S. government is creating a strategic Bitcoin reserve. It's an asset that they can use and weaponize against whoever else is using it in their economy if they choose to, just like oil. That's why I think, Bitcoin, talk about as a replacement for gold, it's going to be weaponized by oil. And that's why that's, in my opinion, we started the spot ETF either way too late, or we shouldn't start it at all. Meaning we opened the floodgates. If we had started it years ago, it would have been, but we're like, that's what government does. Like, we don't know anything about it. Who cares? I'll worry about it when I have to. Now they started it too late. But there is a bonus to this. The government likes Bitcoin because, number one, it is a sponge of some sort. And to your point, number two, they're going to weaponize it, although I don't know how. And number three, related to number two, if you're going to have a bubble in the economy, you may as well just have it be the one. They centralize everything, the government. They centralize risk. They centralize counterparties. They centralize bubbles. They probably want this to happen. At the very least, they could just say, okay, if we ever need to, we can prick this bubble. Of course, it'll destroy the marketplace, but I don't think they understand. I mean, how could I think that they're how could I think? I mean, somebody there's got to be smarter than us. I
Well,
hope, right?
Vince, my point on this is the following: the fact that we have spot Bitcoin ETFs, which
Mhm.
aren't directly held on chain, but they're close enough. They're held by a custodian, so they're backed as of right now by supposedly actual Bitcoin.
Right.
Is in complete and utter opposition to that of the position of the European Union and China. Period.
Explain.
Period. End. Period. End. Okay. Lagarde, like the day the Bitcoin ETFs came out, were approved. The ECB runs this old ass
Oh yeah,
and
yeah.
runs this terrible article. Lagarde is still complaining about Bitcoin.
We own
Okay.
them now.
And the
We
Chinese
own them.
and the Chinese, which had the strategic asset, either
That's right.
negotiated with the United States to all. It was either a strategic negotiation, which
Right.
China said, okay, we're going to take the Bitcoin mining out of China and we're going to hand it to you, the US. That's fine because, and it could have easily been, look,
You
we
want the
need to do
gold? You
this.
can have the Bitcoin.
Well, no. And the reason, and well, there's
Whatever.
that. Yeah.
I mean,
One,
there's
we want
definitely a trade there. There's
we
definitely a
want the
trade there.
gold, you want the Bitcoin. Two, we don't have the spare power grid capacity to
That's
host
right.
this anymore.
That's
And
right.
we need you to offload this in
That's right.
another way. Because
And by
as
the
my
way,
friend,
China
because as
just
my good friend John Seth, who's a real OG in Bitcoin,
Mhm.
described to me a long time ago. I've had John Seth on the podcast before, and his performance, because he's such a sarcastic ass, I love him for it. Went over by like a lead balloon, which was great. Um, he said he described Bitcoin as an organism that lives off of electricity subsidies, and no one as of 2017, 2018 had bigger electricity subsidies domestically than China. Because
Right.
they were selling electricity for 3 cents a kilowatt hour, for Christ's sake. That's why all the Bitcoin miners were there. So
Right.
China had to let those go, had to create a rational market for electricity in China, and that meant the Bitcoin miners were going to leave.
Right.
So you could argue that maybe there was that there was that there was a
Oh no,
thing.
no, no. The short and intermediate goals of China were completely at odds with Bitcoin being a public product there
Mhm.
because they're going to look in China and the BRICS in general, but this is about Bitcoin, right? China is moving to a digital yuan. Now, in the East,
Or at least they're
specifically
trying to.
China, right? They're trying to, right? Right. But in the East, I'm not saying it's easy, but in the East, the digital yuan right now, I'm not saying that people are buying it yet, is trying to be, they can pitch it as an alternative to the dollar. Now,
Yep.
that people are going into gold, but the point is Bitcoin cannibalizes their attempt to get people onto a digital yuan. In
Yes.
the West, as much as we're worried about CBDC, the West is very individualistic, especially the US. And we're like, we don't need an alternative to the dollar. We don't want a digital dollar. We think you're taking our rights. So in the East, this is not me talking. This is actually something Zoltan said about a year and a half ago. He said in the East, it's an easier sell to use CBDCs because they'll use it for international trade, and their people will eventually accept it because they're authoritarian economies. In the West, you can't ram that shit down our throat. So Bitcoin comes to the West, right? China's like, you know what? Get this fucking Bitcoin out of here because we're trying to get people pigeonholed on the yuan. Maybe we'll do that with a little bit of gold tied to the yuan. Maybe we'll just tell them do it or we'll chop your heads off. I don't know, but Bitcoin is the antithesis of authoritarian government, and the U.S. is better. At least they think they are better equipped to handle it.
Well, and that's one way of putting it. The other way of putting it is that simply put that um, we're in the process of finally sovereigntizing our own banking system for the first time in our history. Remember what I've said many times about this. Like go back to the statement by the Chinese foreign minister during the Vietnam. I think it was during the Vietnam War. He said, so he was asked about. It was recently. He's asked about the French Revolution. He said, well, it's too early to tell. I said, well,
Right.
I believe the same thing about the American Revolution. We're finally at a moment here with us declaring independence. I mean, I'm sorry, but Bitcoin, ETFs, and SOFR, and this and everything that Powell's doing, I'm like, dude, this is a statement of sovereignty, of a colony finally saying that's enough. We no longer are owned by you fucking assholes in Europe. You don't own us anymore. We're getting out of the war. Like we're trying to pull out of the war in Ukraine, Vince. Like we really are. The only people who are left are the Schumers and the assholes that are owned and operated by those feckless assholes over in Europe. Like you look at this and you say to yourself, I got all this evidence, and then I got what Europe wants to do, and those two things are completely opposite of each other. And I'm like, do we need to hear any more? Because if you've got monetary sovereignty, in the episode I did with Richard Poe, the last episode we did, episode 171, Richard did a beautiful job of going over how from the time that Cornwallis surrendered at Yorktown until 2022, the British owned our monetary system. The trade, we ran a 10-to-1 trade deficit with these freaking people. Like it's John Adams made the point that it was the tariff and trade structure between the mother country and the colonies that was the impetus for the Revolutionary War. Right. That was what was going on. So then you start thinking about the War of 1812 and the Andrew Jackson and the Central Bank and the Second Bank of the United States and the Panic of 1857 and all of this stuff, and you're like, oh, it's the same shit all over again. We finally are getting to a point where we have ring fence. We have record U.S. oil production, collateral. We have pretty solid American gold production. We're leading the world in Bitcoin mining.
Right.
Market share. Because remember,
we're ready for the change. We're ready for the change.
There's only X number of Bitcoins. It's just a market share game. And then we still have the treasuries, and we still have we still have the dollar. What the fuck do we need a digital dollar for? It's Europe that's broke. It's Europe that wants to seize Russia's foreign exchange reserves so they can start World War III with the Russians in order to default on their sovereign debt. They're the ones who are fucked, not us.
Right. We're declaring financial independence with SOFR and all those things you talked about. And those are like the umbilical cords being broken. But the umbilical cord's the other way around. Right. We've been, I mean, I don't want to sound too, ethno-patriotic, but, we've been carrying them financially for years. And mind you, it's been a symbiotic relationship they've been doing for us. But for one reason or another, the U.S. is saying, you know what, we don't really need you anymore. It really is what's going on. And I mean, economically, I mean, do I want to be partners with Germany? I mean, I'm just going off here, but do I want to be partners with Germany that's letting its industry leave for China? No, the U.S. needs to be partners with China. The U.S. needs to be partners in trade with the BRICS. And, Europe is going to become, I mean, I talk about mercantilism a lot. Europe is on the path back to feudalism. It really is.
Europe is on the path back to becoming a satellite of Russia.
Right.
Where else are they going to get their energy from?
Well, they're going to get it. They're going to get it from us.
Well, that too. But I mean, but our cost of production is too high.
No, but unless we're but tactically,
I don't mean tomorrow. I don't mean tomorrow. They're going to be. I'm talking about 20, 30, 40 years.
Yeah. Geographically, they've got to get their natural gas from Russia. They're not going to get their LNG from us. That's nonsense. They'll be paying. Like if they choose to get their energy from us, they're going to impoverish themselves. We're going to destroy them because our cost is too high. And so,
LNG's cost is too high. The cost of liquefaction of natural gas is more than what the Russians pull it out of the ground and then ship it across and ship it 1,000 miles.
Right. When you look at
liquefaction alone, forget shipping, forget pulling the gas out of the ground and anything else.
In terms of energy, Europe is an island. They don't have oil. They don't have much natural gas. I mean, okay, UK's got oil, but the Brent Sea is going to run out, and then that basis is going to move to Africa. So if you think about it, not to disparage my European brothers, but the colonialism model and mercantilism model that Europe got built up around was basically outsourcing all of your natural resources to your colonies. And
Yep.
now they don't have the colonies anymore. They don't have mines to drill anymore, at least Western Europe. They don't have oil sources. They have beautiful countryside. And guess what? The plantation needs energy. And so, we can drill for it and still live here. Russia's drilled for it. Europe is, a beautiful countryside, and they don't have any natural resources that they can tap into anymore, except
You
for,
can even argue, that half the reason why they're so friggin' angry about Putin taking the Donbass is that that's where all the oil, the natural gas and coal reserves are in Ukraine.
oh yeah,
Oh, by the way,
oh yeah, we're going back to coal. We have to go back to coal. So what happened?
it's like if they want us to drive EVs, we have to stay on coal.
That's right. Look, on average, our carbon footprint is the same, Tom. So it's not a problem. The world will still end 5 years ago, but we got lucky. Who knows? Who knows?
No, no, Vince, you're. This is correct, and this is the thing that's the subplot in all of this stuff. It doesn't. So, I mean, in the long story short, I think what we can say is, as of this moment in time, um, I don't know about you, but I just think the Bitcoin miners. I mean, correct me if I'm wrong, but I think it's a unique opportunity because in this moment in time, Bitcoin is going to rise in price. It may
Right.
go up. It may go. It may do the stair. It may do the stair step up and down thing. It may be ugly going forward, but it has to go up in price
Right.
from where it is, especially if there's the financial and political incentive to have it be a collateral asset
Right.
for the American banking system.
No,
And then the miners trading at unbelievable stink bids are just that can't last. Even if
I
they
think
never see their full flower, they're still you've driven some of these companies down by 40-50% over the last 8 weeks.
I think there's a lot of merit to that, and you know, in this environment, in this secular, globally changing environment, it helps you don't have to know anything. And by that, I mean, you can say, I know this industry is going to do well. You buy a portfolio in the industry, you'll be fine. But when you get to the Bitcoin mining thing, as you said, it's going to be about stock selection. It's not
Yes,
going to be about let's buy a fund of Bitcoin miners. There are
right.
going to be major winners and major losers. So speaking speculatively,
Mm-hmm.
I would say, okay, wait for the halving and buy the best company that's beat down on the block. Don't buy the worst company at the cheapest price. Buy the best company that's beat down. And it's kind of like, it's kind of like I would do an arbitrage trade, but I don't know enough about the actual individual miners. But yeah, you want to find a couple good miners and own them,
Mm-hmm.
I think. And I think you have to understand like you said, you have to understand you have to do the research on their power sources, on their relationships, on their hedging. And well, hedging is probably the least important thing. You want to, like you said, it's about power, right? Can they be the low cost producer? That's what it is. Can they be the low cost producer? And if they are, then they're going to win market share through accretion
Mm-hmm.
and through competition going out of business, which will make them have more coins to sell. Right? They're
And
going to
then
basically
beat the depreciation curve of the mining equipment itself,
right, exactly,
which is a very, very powerful motivator. And this is part of the reason why the marginal producers, you are right that stock selection is important because
yeah,
if you've got a company that is well run with good offtake agreements, co-located with cheap power sources and a growth plan, then you've got and then you've got the winning formula here. In gold, it's always about how good is the deposit because that gives them the most flexibility in terms of how to build out the mine, how to buy financing, and all the rest of it. If they've got a good initial deposit, a good initial look at what's in the ground,
right,
and then still 70% of those don't pan out. I
right,
mean,
right.
it's just because it's just
The thing, I
coal
mean,
mining. It's just a terrible business.
everything about Bitcoin is a known quantity, except the people running the businesses.
Right.
And if you have someone who has made all the right connections business wise, then they're going to win,
Yep.
and they're going to do well. I mean, it's a shrinking. They're going to have an increasing market share, in an asset that's going up in price, and
Mm.
that's a good thing.
Yeah.
Eventually, if I'm a bank and I'm aware of this as a guy who plays the miners short, I'd be like, you know what? It's time. Let's start to cover our shorts in this miner and double down on those miners. Let's just
Yep.
fucking short them to zero because that's what's going to happen. They're
Mm.
going to go to zero, and we'll buy their computers for scrap.
Yep.
That's basically it.
Yep. All right. Sounds great. Do we have anything else we want to talk about?
No, no, not at all. It's actually refreshing to not focus on gold, and I've learned as much as I've said here. I'm going to have to listen to Caitlin's interview and do a little bit more digging about the whole mining thing because the bank research that I get, they're notoriously not talking about miners, and that means they've found something that they're doing. They'll talk about something after they've pretty much demystified it, but they're doing something there. Also, I'll send you that Standard and Charter report. I think your people will
That
appreciate it.
that'd be great. So as always, Vince, tell everybody where they can find your work and what you do and all the rest of it because my friend, it's always a hoot.
Yeah. I have a newsletter. I'm a trader in commodities derivatives for 30 years, and I started a newsletter in 20 during COVID, and it's called VBL. Just go look for Goldfix, and you'll get goldfix.substack.com, and you'll find me. It's primarily about obviously it's monetarily centered, gold and silver and Bitcoin to a lesser extent, focused on economics and secular change. And we do a lot of proprietary research, as well as share research we get from excerpts from banks. So if you're interested, come to that, sign up for free, and we'll spam you until you go premium. But if you want to sign up for premium, Tom will have a link for 30% off. That's it.
As always. Yep. And as always, you can find me at TFL 1728 talking to Vince Sorenthek, Sorenthek, where we try to at least be entertaining, if not downright assholes on Twitter,
That's
because
right.
it's way too much fun. All right,
That's
Vince, that sounds great. So we'll talk soon.
Thanks, Tom.
And that'll about wrap it up for episode 172 of the Gold, Goats, and Guns podcast. I want to thank Vince for a little bit of like hazard pay because I wanted to talk about things originally that he wasn't quite prepared to talk about. So we went off in a slightly different direction. We talked about things he wasn't an expert in, and he, as always, knocked it out of the park as far as I'm concerned. So I have to, review my own podcast before I put it out the door. As always, you can follow my work over at my blog at goldgoatsandguns.com. You can follow me on Twitter at TFL1728. You can follow, as I said during the end of the podcast, you can follow Vince over at Sorenthek, Sorenthek. These will all be in the show notes, folks, so don't really worry about it. And of course, you can sign up for the Patreon over Patreon.com/goldgoatsandguns, where you can sign up for either the twice weekly podcasts and private blogs or the monthly newsletter where we do all original material, myself and Dexter White, and have a portfolio strategy for helping you make sense and hopefully make some money in this crazy freaking world. So with that said, I'm out. You guys be well. You take care. We'll talk soon. Keep your stick on the ice.